Hello everyone, welcome back to my channel, and in today's video I will take you through step-by-step journey of an equity deal process from a sell side perspective. So we'll discuss starting from seller's intent to sell its business, either 100% or part of its equity, to the deal closure. Alright, so let's get started. The first step is selling intent. So let's say I am an owner of a business. I own 100% equity. I am 70 years old and looking for retirement. And for the same reason, I want to exit from the business. Now I can look for a buyer by myself or hire someone who is specialized in this process. So let's say I hire an investment banker for it. Investment banker will represent the companies for the sale or dilution of the equity. So in this example, we are looking for 100% sale. There could be a cases where a seller would be selling a part stake, either majority or minority. Okay, let's move to step two. In step two, investment banker prepares an investment teaser in order to look for potential buyers. Now, investment teaser is nothing but one or two slide document which summarize the company background and is mostly on a no name basis. So let's go through the slide. The investment banker prepares an investment teaser, a one or two slide summary of a potential sale process without mentioning the name of the potential target company in order to maintain the company's identity as confidential. I have a sample for you. Okay, so this is how an investment teaser look like, although you have name here, but mostly it's on a no name basis. So in this document, you have brief background of the company, detailed on financials, background of management, etc. The third step is signing of NDA, which is non-disclosure agreement. Now, in step two, investment bankers distributed investment teaser to certain potential buyers, and out of them, few are interested to take this process forward. Now, because the investment teaser was on a no-name basis, and now they want more information about the company, what investment banker does is it asks for non-disclosure agreement, which means that in case we if we provide you more details on the financials, background of the company, background of the promoter, etc., then you have to sign a non-disclosure agreement where the information that we will share throughout this process will be confidential and cannot be shared with any third party. So now once we have the non-disclosure agreement in place, we can go to pitch deck. Now in pitch deck, basically it's a detailed document, much more detailed than investment teaser, which has all the details about the background of the company, the product, its product journey, the journey of company itself, management, what is its long-term strategy, in case if they have provided some projections, how they're going to achieve those projections, what is the long-term plan, etc. So it is much more detailed than investment teaser. I have a sample of information memorandum, and if you see, it comprises of 63 pages. It includes executive summary, company overview, market overview, company positioning, product overview, client sales and marketing overview, growth strategy, and other important details. So in the executive summary, you have key information pertaining to the company. If you go down, you will get the details on the background of the company, its product, its market, key company milestone over the years. So like you see, it's a detailed document, and what it covers we have seen in the table of content. So through pitch deck, buyers get an access to the information about the company at a great length. So let's go what the slide is saying. The investment bankers share the CIM, which is confidential information memorandum, also known as pitch deck or memo, with the investor buyer firm. The CIM is generally a presentation of 50 to 100 slides. With the information given in the pitch deck, what the buyer can do is it can build its own financial model, generally a leverage buyout model, and perform some initial research. The buyer, after doing independent research and preparing a financial model to come up with a range of values, goes to the next step, which is preparation of indication of interest. The buyer or investor will put the range of values on the basis of its financial model. So let's say based on financial model, the range is 500 million to 600 million. So what they'll do is they will put this 500 to 600 million in indication of interest, and submit to the investment banker. Now, the investment banker would have done their own valuation. So, let's say based on investment banker's valuation, the value of a company is around 900 million. Now, this 900 million and 500 and 600 million is not at a handshaking distance. There could be a possibility that investment banker will turn down this offer, or let's say otherwise based on investment banker the valuation is around 700 million. So the 700 million and 500 600 is at handshaking distance. So what they can do is they can move to the next step, which is the letter of intent. I'll just quickly go through the slide as well. In LOI, if the investor buyer firm is satisfied, they will submit an IOI, indication of interest, which means that they are interested in learning more about the valuation range. Then the seventh step is investment banker will continue the process if they feel the IOI is within the range. So in our case, it is within the range. So let's move to the next step, which is LOI, letter of intent. The investor or buyer firm does more diligence and eventually submit a document called LOI, letter of intent, which means that they are interested in buying the company, assuming all our diligence checks out, but the document is non-binding. So I'll just give you a quick look at all the documents which we are talking about and the differences. So first is the indication of interest. It is non-binding and non-exclusive. The second is letter of intent, which is in good faith and exclusive. We'll come back to purchase agreement when we'll discuss that. Okay, coming back to LOI, because buyer is interested and submitted a letter of intent, the investment banker can move to the next step, which is a formal meeting. The investment banker set up a meeting with the seller where buyer get a chance to directly interact with the seller and know business better, especially taking a physical tour of the business and so on. So the investment banker set up meeting with the investor buyer firm and the company so that everyone gets to know each other better. Generally on-site meeting. It includes business tour, question and answer, negotiation, etc. Okay, now the next step is due diligence. So far the buyer is relying on the information shared by seller or its investment banker. However, in this stage, they do a detailed independent due diligence exercise, and in most of the cases, they hire some specialist for legal due diligence as well as financial due diligence. So in legal due diligence, they look at any risk from legal perspective or litigation perspective. In the financial due diligence, look out for any red flag in terms of financial numbers, whether the financial numbers provided to buyer really represent the true picture of the business. Look for any error, look for any misstatement, etc. So let's say once legal and financial due diligence is done and everything looks fine, then they move to next step, which is stock purchase agreement. Once satisfied, it moves to legal stage where lawyers trade drafts of the stock purchase agreement. The agreement should mirror the terms in the LOI or the latest understanding between everyone. Okay, let's go back to this table. The purchase agreement is legally binding, whereas the letter of intent and indication of interest are non-binding. So we have a stock purchase agreement in a draft format. After that, what the investor or buyer does is it tracks the performance for 3 to 9 months, and everything goes well. Due diligence goes smooth and the performance of the business is as per the expectation. They finally close the deal and sign off the stock purchase agreement. So let's go through the slide. The investor firm keep track of the business performance for further months, generally 3 to 9 months. If the business continues to perform well, diligence continues smoothly, and everyone is in agreement on the legal stuff, then the deal closes. All right, with 13th step, we have concluded our journey of equity deal process. Like always, I hope you had a great learning session, and I see you the next time. Thank you.